You know, in business school, they teach you a very simple principle. The customer is king. You want as many customers as possible. You want them to buy as much as possible. If someone walks into your store with cash in their hand, you take it. That is how capitalism works. But apparently on Monday, January 19th, 2026, the rules of capitalism have been suspended. We have just received an emergency communication from the CEO of APMEX, Ken Lewis. For those who do not know, APMEX is the Amazon of precious metals. They are the largest online retailer of gold and silver in the United States. They set the tone for the entire physical market. And this letter is not a marketing email. It is a distress signal. Effective immediately, APMEX has instituted a mandatory minimum order size of $500 for all online transactions. Now you might hear $500 and think that isn't a lot of money. And for a whale, it isn't. But for the average person, the person trying to protect their savings from inflation 1 ounce at a time, this is a locked door. Why would a business turn away customers? Why would they tell the small stacker, your money is no good here? They tell us it is to assist in efforts to get back to service levels. But let's translate that into plain English. It means they are drowning. It means their systems are breaking under the strain of the panic buying we witnessed this weekend. When a retailer imposes rationing, and make no mistake, a minimum order size is a form of rationing, it is because they have lost control of their inventory management. They are trying to slow down the flow of metal leaving the vault. They are prioritizing the whales and sacrificing the minnows. This letter confirms the retail tsunami we discussed in our previous report. The CEO explicitly states that silver demand increases have far surpassed gold over the last 6 weeks. This is critical. Gold is the asset of the central banks. Silver is the asset of the people. When silver demand outpaces gold demand by this magnitude, it means the public is waking up. It means the average citizen is realizing that the dollar is losing value faster than they can earn it. But the most terrifying part of this letter is not what it says about demand. It is what it implies about supply. If MEX had unlimited silver, they would hire more staff. They would expand their shipping department. They would take every single order, no matter how small, because every order is profit. The fact that they are willing to turn away 50% of their order volume, yes, the letter says small orders represent 50% of volume, tells you that the profit is no longer the priority. Survival is the priority. They are circling the wagons. We are seeing the bifurcation of the retail market. If you have capital, you can still get metal, albeit with delays. If you do not have capital, you are being pushed out of the lifeboat. This $500 minimum is just the first step. What happens next week? Does it go to $1,000? Does it go to $5,000? We already saw them implement a $10,000 minimum for sellback orders earlier. Now they are restricting the buy side. They are tightening the noose. This connects directly to the price action we are seeing on the screen. Silver is trading at $94. It is an all-time high. In a normal market, high prices cure high demand. People stop buying when things get expensive. But APMEX is telling us the opposite is happening. They say demand is increasing despite the record price. This is the definition of a GIF and good. It is an economic paradox where demand rises as the price rises because the asset is essential and people fear they won't be able to get it later. The public isn't buying silver because it is $94. They are buying it because they are terrified it is going to $200. And based on this letter, their fear is justified. The CEO admits that they are working long hours and weekends just to keep up. This is a system running at 110% capacity. Systems that run at maximum capacity are fragile. One more shock, one more demand spike, and the whole thing collapses. For the individual investor, this letter is a warning shot. It says that the window of easy access is closed. You can no longer just wake up, decide to buy a single coin, and have it shipped to your house. That luxury is gone. You now have to plan. You have to accumulate capital. You have to compete with the big money. The democratization of silver is ending. We are returning to a time where precious metals are the exclusive domain of the wealthy and the well-connected. And remember, APMEX is the biggest player. They have the deepest pockets and the best supply chains. If they are rationing, imagine what is happening at the local coin shop in your town. Imagine what is happening at the smaller online dealers who don't have APMEX's relationships. They are likely already dry. The $500 wall is a sign that the physical market is breaking down. The friction is increasing. The velocity of metal is slowing down not because people don't want it, but because the system can't process the transaction. This is what a liquidity crisis looks like in the physical world. It isn't a lack of cash. It is a lack of logistical bandwidth to move real assets into real hands. In the next part of this deep dive, we are going to look at the demand shock numbers provided in this letter. The CEO gave us specific data points for a normal Saturday that paint a picture of absolute mania. We are going to analyze why this specific weekend, January 17th and 18th, became the tipping point, and we are going to discuss the anti-copycat message. Just like APMEX is protecting their inventory, we need to protect our research. The rationing has begun, the minimums are here, and the price is vertical. If you thought it was hard to buy silver yesterday, just wait until you see what happens tomorrow. We need to look closely at the numbers Ken Lewis shared in his letter. CEOs generally do not share specific internal data unless they are trying to explain a catastrophe. They keep their cards close to their chest. But in this letter, he laid his cards on the table, and the hand he is holding is terrifying. He revealed that Saturday, January 17th, was the third busiest Saturday in the company's history. He quantified it. He said volume was 4 times a normal Saturday. Let's contextualize that. Saturday is usually a quiet day in the precious metals market. The spot market is closed. The banks are closed. People are at their kids' soccer games or doing yard work. They are not frantically refreshing a bullion dealer's website to buy silver bars. A 4x increase in volume on a Saturday is not organic growth. It is not a marketing campaign working well. It is a panic. It means that while the markets were closed, the American public was sitting at home reading the headlines about the U.S. Mint suspension and the tariff wars. They decided that they could not wait until Monday. They decided they had to get their money out of the banking system immediately. This is what a bank run looks like in the digital age. It doesn't look like a line of people around the block. It looks like server traffic spiking by 400% on a weekend. And remember, this happened before the price hit $94 on Monday. These buyers were paying $89 or $90 plus premiums. They were paying over $100 an ounce, and they were buying 4 times more than usual. This destroys the deflationary argument. The deflationists tell you that people won't buy if the economy is crashing. But here we have proof that people are panic buying safe haven assets at record prices. The letter goes on to say that last week was the 4th highest week in our history. Think about the other weeks in history that might compete with this. The banking crisis of 2008, the CO crash of 2020, the silver squeeze of 2021. We are in that territory again. We are living through a historical anomaly. But there's another data point in this letter that is even more telling. The CEO writes, silver demand increases have far surpassed gold. And he notes that demand for silver as a percentage of our revenue hit a new all-time high. This is the poor man's gold thesis playing out in real time. Gold is trading at $4,600. For the average family, buying a one-nosed gold coin is a major financial decision. It is expensive. It is psychologically heavy. But silver, even at $100, silver feels accessible. You can buy a tube of silver. You can feel the weight. It feels like you're getting more for your money. This unit bias is driving the capital flows away from gold and into silver. Because the silver market is so much smaller than the gold market, this wave of capital is drowning the available supply. It is like trying to force the water from a fire hose through a drinking straw. The pressure is blowing the pipe apart. This brings us to a critical realization. The paper price on the COMEX is being set by algorithms tracking the dollar index and interest rates. But the physical price is being set by a retail mob that has lost faith in the system. The two are not speaking the same language. The algorithm sees high interest rates and thinks sell silver. The public sees U.S. Mint closed and thinks buy silver. The public is winning. The 400% increase in volume proves the physical buyer is now the dominant force. Before we move on to the supply collapse, I need to address something important regarding our community. We are boring currency. This is the original channel. We spent hours analyzing these CEO letters and tracking the vault data to bring you the truth. But just like there is fake paper, there are fake channels appearing on YouTube and Twitter. We have noticed a surge of copycats using the same AI avatar. They are ripping our scripts. They are stealing our thumbnails. They are trying to trick you into thinking they are us. I want to be crystal clear. We have only one channel. It is this one. We are only on YouTube. We do not have a Twitter account under a different name. We do not sell crypto on Telegram. We are not asking you for money on WhatsApp. The other people using this avatar are not affiliated with us. We do not take responsibility for their info. We provide this video with a lot of research because we respect you. We want you to have the real data, not a cheap knockoff. So, please help us fight the fakes. Go down to the comment section right now and type "staying with the original." Let the algorithm know that you know the difference between the real analysis and the copycat noise. We read every comment, and your support means everything to us. Now back to the APMEX data. The fact that demand is hitting all-time highs while the U.S. Mint is closed creates a perfect storm. Usually, when demand spikes, the dealer calls the Mint and orders more coins. But the Mint isn't picking up the phone, so APMEX has to go to the secondary market. They have to buy silver back from customers. But the letter says that sellback orders have dropped. Even with the price at record highs, people are not selling their silver back to the dealer. They are holding. So you have record buying demand and falling selling supply. In economics, this is called a supply shock. And this brings us to the most dangerous revelation in the CEO's letter. He admits that their internal production capacity has collapsed. He says, our output will be impacted by approximately 50%. 50%. This is the smoking gun. This is the detail that proves the system is broken. Why would output drop by 50% right when demand is at an all-time high? A rational business would run 3 shifts. They would pay overtime. They would ramp up production to meet the demand unless they physically cannot get the raw material to produce the rounds. In the next part of this deep dive, we are going to investigate this production collapse. We will explain why APMEX suddenly lost half of its capacity. We believe this is due to a shortage of silver grain. Silver grain is the raw industrial feedstock used to make coins and bars. If the refiners are out of grain, the mints cannot mint. It doesn't matter how many workers you have or how much demand you have. If you don't have the silver shot, the machines stop. The 4x demand shock has collided with a 50% supply cut. Do the math. Demand is up 400%. Supply is down 50%. This creates a gap that can only be filled by one thing: price. The price has to go higher. Much, much higher. It has to go high enough to destroy the demand or force new supply out of hiding. At $94, that clearly hasn't happened yet. The panic is accelerating. The shortage is deepening. And the largest dealer in America just told you they are running at half speed. This is not a drill. This is a logistical failure of the silver market. In part 3, we will dissect the supply failure and the refusal to pre-sell inventory. The dealer has admitted they don't know if they can get metal next month. If they don't know, how can you? We need to drill down into the single most terrifying sentence in the letter from Ken Lewis. Amidst all the talk of volume and minimums, he dropped a bombshell. He wrote, "Our output will be impacted by approximately 50%. Read that again, 50%. APMEX is not just a retailer. They own their own mint. They produce over 90% of their branded silver bars and rounds in-house. They control the machinery, they control the labor, they control the schedule. So why would their production collapse by half right now? If you run a factory with customers waving cash, you don't cut production. You add shifts. You run the machines 24 hours a day until they melt. Unless you can't. Unless the one thing you need to run the machine is missing. We believe the private minting industry is facing a catastrophic shortage of silver grain. Silver grain or shot is the industrial feedstock for the minting world. To make a coin, you melt down the grain, cast it, punch out blanks, and stamp them. If you don't have the grain, you don't have a product. And where does the grain come from? It comes from the major refiners. If APMEX's output is down 50%, it is because the refiners are only sending half their order. The tap has been turned down. Are the refiners out of metal, or is the metal going somewhere else? To answer that, we have to look at the data from the Asian markets. While APMEX was writing this letter, the Shanghai Gold Exchange closed its Monday session. The PM fix for silver in Shanghai hit $13.26. Let's do the math. The spot price in New York is $94. The spot price in Shanghai is $13. The spread is $9. If you are a global refiner, you have a choice. You can sell grain to APMEX in the United States for $94, or you can cast it into kilobars and ship it to Shanghai for $13. You make an extra $9 on every single ounce by snubbing the American consumer. You feed the Chinese industrial complex instead. This is why APMEX has no grain. The Shanghai magnet is sucking raw material out of the supply chain. The United States is being starved. The demand shock is hitting a 0x supply reality. This explains why the premiums are exploding. The premium is the dealer trying to outbid Shanghai to get the metal to stay in the US. But at $94, they can't compete. They have to charge you $120 just to cover the replacement cost. This leads us to the second critical policy change in the CEO's letter, a policy that signals the end of the futures market for retail investors. Ken Lewis wrote, "We will not pre-sell inventory 30-plus days out." This is a stunning admission. In the bullion business, pre-selling is standard to lock in prices and hedge risk, but APMEX just said no more. Why? Because they don't know if they can get the metal or what it will cost. If they sell you a bar today for $94, delivery in 30 days, they take a massive risk. What if the Shanghai price goes to $150 next week? The refiner will raise the price of grain. APMEX would have to buy the metal at a loss to fulfill your order. They would go bankrupt. By refusing to pre-sell, they are admitting the price mechanism is broken. They have zero visibility into the supply chain beyond the next few weeks. This is a force measure in slow motion. They are preemptively canceling the future because it is too volatile to ensure. This forces the market into hand-to-mouth trading. You can only buy what sits on the shelf, and the shelves are empty. So, we have a 50% production cut, a refusal to sell future inventory, and mandatory minimums. This is the collapse of the retail distribution network. The paper price of $94 is becoming irrelevant because you cannot transact at that price. The infrastructure required to move physical silver to your pocket is disintegrating. The refiners are bypassing the mints. The mints are bypassing the public. And the public is left holding paper dollars that are losing value by the second. This is why the tariff news is so critical. The government knows the refiners are shipping everything to China to capture the arbitrage. President Trump's tariffs are an attempt to build a wall to keep the metal here, but capital is like water. It finds a crack. And right now, the crack is the refiner's margin. So what is the verdict on the production collapse? It means that the supply shock is not temporary. It is structural. Until the New York price matches Shanghai, the metal will continue to flow east. The US Mint cannot fix this. APMEX cannot fix this. Only the price can fix this. We are looking at a scenario where available inventory is the only metric that matters. If you see a coin in stock, buy it. It doesn't matter if the premium is high or the chart looks overbought. Buying silver today is not about investing. It is about securing. You are securing a claim on a finite resource being reallocated to the other side of the world. The CEO of the largest dealer in America just told you he's running out of options. He's running out of capacity. He's running out of metal. In the final part of this deep dive, we are going to look at the end game. We are going to map out what happens when the 30-day window closes. We are going to discuss the secondary market and junk silver. The banks are trapped, the dealers are broken, and the Shanghai price is $13. The squeeze is no longer a theory. It is a logistics receipt. We have arrived at the conclusion. If you have been with me, you understand the scope of this emergency. You understand the rationing, the demand shock, and the production collapse. The primary market for new, freshly minted bars is broken. The machinery is seized up. When a river is dammed, the water finds a new path. In the silver market, that path leads to junk silver. A junk silver refers to pre-964 United States coinage. Dimes, quarters, and half dollars minted with 90% pure silver. They are not junk. They are constitutional money. They are the last remnants of a time when the dollar was worth something. Junk silver does not need to be refined or minted. It already exists. It is sitting in bags, vaults, and jars and basement across the country. When the supply of new eagles and bars fails, demand shifts to the secondary supply. We predict the premium on junk silver is going to detach from reality. Think about the utility. In a currency crisis, you want fractional silver. You want small denominations for trade. A silver quarter is perfect for buying groceries. A 100 bar is not. The smart money knows this, and dealers are scrambling to buy back old metal. But people are not selling. They're preserving wealth. This creates a Gresham's Law event on steroids. Gresham's Law states that bad money drives out good. People spend the bad paper dollars and hoard the good silver coins. We are about to see the supply of junk silver vanish from the open market. If you can find 90% silver at a reasonable price, it might be the last time. This brings us to the peer-to-peer future. If APMEX has a minimum and the local shop is empty, you buy from each other. We are going to see the rise of a gray market for silver, private transactions, cash deals, handshakes. In a peer-to-peer market, the spot price on the screen is a joke. The price is whatever the seller demands. If you're holding silver, you're now the central bank. You set the price. You don't sell for $94. You sell for what it costs to replace it. This is the ultimate decentralization of the monetary system. The banks lost control. The dealers lost capacity. Power rests with the holder. So, what is the verdict? The paper era is dead. When the CEO cannot plan 30 days ahead, the system is unstable. They are cutting off small orders to preserve inventory for a price reset. They want to hold that silver until it hits $150. It is inventory management in the face of hyperinflation. So, strategy number 1. Do not be picky in this market. You take what you can get. Rounds, bars, or junk silver. Weight is weight. Atoms are atoms. When the price hits $200, nobody cares about the picture on the coin. Strategy number 2. The Shanghai Watch. As long as that price gap exists, the drain to the east continues. We expect the US price to gap up to close that spread. The short squeeze is now being driven by the physical squeeze. The banks are trapped. The dealers are trapped. The public is trapped. The only escape is the metal. Thank you for trusting us with your time. Clarity is power. And once again, a reminder, we are boring currency. We are the original. We are not on Twitter selling scams. Leave a comment saying staying with the original to lock in your support. The dealer has spoken. The factory is broken. The supply is gone. You have the intel. Now you have to make the move. Stay safe. Hold on to your constitutional money. Welcome to the shortage. Subscribe.